Hello everyone. Today we will talk about strategy formulation, corporate strategy. The vignette about Nike emphasizes the vital role of corporate strategy in a firm's survival and success. Corporate strategy addresses three key areas: directional strategy, portfolio analysis, and parenting strategy. Directional strategy pertains to the overall orientation of the firm, whether it focuses on growth, stability, or retrenchment. Portfolio analysis involves determining the industries or markets where the firm competes through its various products and business units. Lastly, parenting strategy centers on how management coordinates activities and allocates resources among these units. In large multinational corporations, corporate strategy is particularly crucial for managing diverse product lines and business units to maximize overall value. In this context, corporate headquarters functions as a parent, overseeing its children, the various units, to ensure that their individual strategies align with the corporation's overall goals. While each unit may pursue its own competitive advantages, effective coordination is essential for the success of the corporation as a whole. Corporate strategy includes decisions about resource allocation and the sharing of skills across units to achieve synergy, making the organization more effective than the sum of its parts. The chapter is organized into three parts that explore these aspects: directional strategy, portfolio analysis, and corporate parenting, providing a comprehensive understanding of corporate strategy's significance. Every corporation must establish its directional strategy by addressing three critical questions regarding its operations and growth orientation. First, it needs to determine whether to expand, cut back, or maintain current operations. Second, the corporation must decide whether to focus on its existing industry or diversify into other industries. Lastly, if growth and expansion are desired, the corporation must choose between internal development or external methods such as acquisitions, mergers, or strategic alliances. Directional strategies typically fall into three broad categories, often referred to as grand strategies. Growth strategies aim to expand the company's activities and market presence. Stability strategies maintain the current level of operations without significant changes. Retrenchment strategies involve reducing activities to improve efficiency or address challenges. Once a corporation identifies its general orientation, such as a focus on growth, management can then select more specific strategies. These might include concentrating on a single product line or diversifying into multiple products or industries. This approach applies to both corporations with a singular focus and those operating across various industries with multiple product lines, allowing for tailored strategies that fit their specific circumstances. Growth strategies. Growth strategies are among the most commonly pursued corporate directional strategies, focusing on increasing sales, assets, and profits. Companies operating in expanding industries must prioritize growth to ensure survival. Continued growth allows firms to boost sales, leverage the experience curve to lower per-unit costs, and enhance profitability. This cost reduction is crucial, especially in rapidly growing or consolidating industries where competitors may engage in price wars to capture market share. Companies that have not achieved critical mass or the necessary scale for efficient production face significant risks unless they can identify and exploit profitable niches where they can command higher prices due to unique product features or services. For instance, Oracle's acquisition of PeopleSoft in 2005 illustrates this approach, as Oracle sought to enlarge its size to compete effectively with larger competitors like SAP and Microsoft in a maturing software market. A corporation can pursue growth through internal means, such as expanding operations both domestically and globally, or through external avenues like mergers, acquisitions, and strategic alliances. Mergers involve two or more corporations exchanging stock, resulting in one surviving entity, often with a name derived from the merged firms, such as Allied Signal from Allied Corporation and Signal Companies. In contrast, an acquisition refers to the purchase of a company that becomes a subsidiary of the acquiring corporation, as seen in Procter & Gamble's acquisition of Gillette. Acquisitions can occur between firms of varying sizes and may be friendly or hostile, with hostile takeovers being a common term for adversarial acquisitions. Growth strategies are appealing for several reasons. First, increasing market demand can obscure underlying flaws within a company that would be more apparent in stable or declining markets. A growing revenue stream can create organizational slack, providing resources to address conflicts and issues swiftly. Additionally, growth offers a buffer against strategic missteps and enhances a firm's bargaining power with stakeholders. Second, a growing company presents more opportunities for employee advancement and excitement, which can enhance the ego of executives. Larger firms are often perceived as more stable or successful, leading to increased investor confidence and potentially higher executive compensation. Consequently, the two primary growth strategies are concentration on current product lines within a single industry and diversification into new product lines across different industries. OK. Concentration strategies. Concentration strategies focus on leveraging a company's existing product lines that show real growth potential. Companies typically adopt these strategies before pursuing diversification and can choose between vertical and horizontal growth. Vertical growth involves expanding by assuming control over functions previously managed by suppliers or distributors. This can be achieved through internal development, such as expanding production facilities, or through external acquisitions. For example, Henry Ford's River Rouge plant showcased internal vertical growth by integrating the entire manufacturing process. In contrast, Cisco Systems pursued external vertical growth by acquiring Scientific Atlanta to enhance its distribution capabilities. Vertical growth results in vertical integration, which can be categorized as backward integration assuming supplier functions or forward integration taking over distributor functions. Companies can gain competitive advantages by controlling resources and distribution, although backward integration is generally more profitable than forward integration. While vertical integration can provide efficiencies, it also has drawbacks, such as reduced strategic flexibility and potential exit barriers due to heavy investments in specialized assets. Transaction cost economics suggests that vertical integration is efficient when market transaction costs are high, but excessive internal bureaucracy can make outsourcing a more attractive option. The degree of vertical integration can vary, from complete ownership of the value chain to various hybrid approaches like taper or quasi-integration. In taper integration, a firm produces some of its needs internally while sourcing the rest externally. Quasi-integration involves a company relying on outside suppliers while maintaining some level of control, such as partial ownership. Long-term contracts can also facilitate relationships without full integration, although exclusive contracts may create dependencies akin to vertical integration. Recently, there has been a shift from vertical growth strategies toward cooperative relationships with suppliers and even competitors. These include outsourcing, where companies source resources externally, and strategic alliances, which enhance capabilities through partnerships and joint ventures. This approach allows firms to remain competitive while leveraging specialized expertise from other organizations. Horizontal growth. Horizontal growth allows a firm to expand its operations into new geographic locations and broaden its range of products and services within existing markets. Research shows that companies that pursue horizontal growth by diversifying their product lines tend to have higher survival rates. This approach results in horizontal integration, where a firm operates at the same level of the industry's value chain across multiple locations. For instance, Procter & Gamble P&G exemplifies horizontal growth by continuously expanding its product offerings and introducing successful items from one region to others. The company has effectively launched popular American brands like Head & Shoulders and Tide in markets such as China, where it has built a significant presence with a large workforce and a robust distribution network. Horizontal growth can be pursued through internal development or by forming external partnerships, such as acquisitions and strategic alliances. A notable example is Delta Airlines' acquisition of Northwest Airlines, which provided access to new Asian markets and expanded its service offerings in the US. Similarly, smaller commuter airlines often enter long-term contracts with major airlines to enhance their service offerings, as seen with Mesa Airlines partnering with United Airlines and others to operate under different brand names. In the current global marketplace, horizontal growth is increasingly realized through international expansion. Major supermarket chains like Walmart, Carrefour, and Tesco have successfully extended their operations across borders, adopting various strategies to facilitate this growth. This trend reflects the importance of broadening market reach and product offerings to maintain competitiveness and capitalize on new opportunities. International entry options for horizontal growth. International expansion is closely linked with firm profitability, and companies can choose from several strategies to enter foreign markets or set up overseas operations. These options differ in cost, complexity, and risk. 1. Exporting. Low-risk entry by selling home country products abroad, often with the help of export management firms, popular with small businesses due to modern communication tools. 2. Licensing. Grants another firm rights to produce/sell products in exchange for royalties or fees, useful when brand recognition is strong but capital is limited. 3. Franchising. Allows firms to expand retail presence internationally by letting franchisees use their name and system, paying royalties, a major global growth method in retail. 4. Joint ventures. Partnerships with local firms or governments to share resources and reduce risk, popular when countries restrict foreign ownership like Walmart in India with Bharti. 5. Acquisitions. Quick entry by purchasing established firms, gaining market presence and distribution networks often favored by experienced international firms like InBev acquiring Anheuser-Busch. 6. Greenfield development. Building facilities from scratch abroad. Expensive but allows full control and customization like Toyota and BMW factories. 7. Production sharing outsourcing. Splitting production between developed and developing countries, combining advanced skills with low-cost labor like IT and manufacturing in India, Mexico. 8. Turnkey operations. Firms build facilities for a fee, then hand them over to the host country once complete. often used for large government projects. 9BOT: build, operate, transfer, a variation of turnkey where the firm operates the facility for a period to recover investment before transferring it. 10. Management contracts. A firm provides managerial expertise to a host country's company for a fee, often after expropriation, allowing continuity of operations. Diversification strategies. Diversification strategies are typically considered by companies when their growth in existing markets has plateaued and opportunities have dwindled. This often occurs in mature industries where firms may need to explore new industries to continue their growth. The two primary types of diversification strategies are concentric related diversification and conglomerate unrelated diversification. Concentric diversification involves expanding into related industries, which can be advantageous for firms with a strong competitive position in their core business. Companies that lead in their field have a significantly higher probability of success when diversifying into related areas. This strategy leverages the firm's existing strengths, such as product knowledge, manufacturing capabilities, and marketing skills, to secure a strategic fit in a new industry. The goal is to achieve synergy, where the combined operations generate greater profits than they would separately. For instance, Bombardier successfully diversified from snowmobiles into aircraft manufacturing by acquiring companies like Canadair and Learjet, utilizing its transportation expertise. Firms can pursue concentric diversification through either internal development or external acquisitions. For example, Bombardier opted for external growth through acquisitions, while Toro expanded internally by applying its existing manufacturing processes to create new products like snow blowers. Conglomerate diversification is pursued when the current industry appears unattractive and the firm lacks transferable skills for related industries. This strategy focuses on financial considerations, such as cash flow and risk reduction, rather than product-market synergy. Companies like General Electric and Berkshire Hathaway exemplify successful conglomerate diversification. Berkshire Hathaway, under Warren Buffett, has interests in diverse sectors, including retail and publishing, emphasizing sound investment and value-oriented management. Conglomerate diversification can also be strategic for firms with uneven cash flow, allowing them to stabilize their revenue by acquiring businesses in unrelated industries that complement their seasonal sales patterns. For instance, CSX Corporation considered buying a natural gas transmission company to balance its cash flow during lean periods in its railroad operations. Controversies in directional growth strategies. The debate over the effectiveness of different growth strategies, such as vertical versus horizontal growth, concentration versus diversification, and concentric versus conglomerate diversification, reveals that related diversification tends to yield better performance and longer survival rates compared to narrower concentration strategies. Research indicates that companies pursuing related diversification generally outperform those focused solely on concentration. For example, a study showed that vertical growth had an 80% success rate, while horizontal growth, concentric diversification, and conglomerate diversification had success rates of 50%, 35%, and 28%, respectively. This suggests that companies should first leverage their existing capabilities before venturing into new areas. In terms of diversification strategies, the relationship between relatedness and performance follows a curvilinear pattern. Businesses that are too similar may not add significant value, while those that are completely unrelated may lack synergy. However, businesses that are different yet related can lead to substantial performance improvements. Regarding growth methods, corporations can grow internally by developing new products or externally through acquisitions. Although the value of global mergers and acquisitions has risen dramatically, research generally indicates that companies growing internally tend to perform better financially than those relying on acquisitions. For instance, HP's acquisition of Compaq resulted in a decline in stock value, illustrating the risks associated with high acquisition costs and reduced investment in R&D. Additionally, customer satisfaction often declines post-merger. To enhance acquisition performance, companies should align acquisitions with strategic objectives and be prepared to evaluate numerous candidates. Successful acquirers often start with small, low-risk acquisitions and leverage prior experience with potential targets. Cisco, for instance, uses specific criteria for acquisitions, including the target size, cultural fit, and geographical proximity to existing operations. Overall, a balanced approach that combines internal and external growth strategies may yield the best results. Stability strategies. Stability strategies involve a corporation maintaining its current activities without significant changes, which can be suitable for successful companies in predictable environments. While often viewed as a lack of ambition, these strategies are popular among small businesses that have found a stable niche. However, relying on stability for too long can be risky. 3 common stability strategies include pause/proceed with caution strategy. This strategy serves as a timeout for a company to consolidate resources and make incremental improvements before continuing with growth or retrenchment. For example, Dell adopted this approach after experiencing rapid growth that outpaced its operational capacity, allowing it to reorganize and address growing pains. No-change strategy. A no-change strategy involves continuing current operations and policies without significant adjustments. This approach is viable in stable industries where no major threats or opportunities exist, allowing the company to maintain its profitable niche. However, this strategy can be problematic if external conditions change significantly, as seen when small-town businesses struggled after larger competitors like Walmart entered their markets. Profit strategy. This strategy entails maintaining the status quo in the face of declining sales by reducing investments and short-term expenditures to artificially support profits. Management might blame external factors for the company's troubles while deferring necessary investments. While this can provide temporary relief, it can lead to a long-term decline in competitive position if not addressed proactively. Ultimately, a more direct approach, such as a retrenchment strategy, is often more effective in responding to challenges. Retrenchment strategies. Retrenchment strategies are employed by companies facing weak competitive positions and declining performance. These strategies aim to improve performance by addressing weaknesses that lead to poor sales and profitability. Several approaches to retrenchment include turnaround strategies, captive company strategies, sell-out divestment strategies, and bankruptcy liquidation strategies. Turnaround strategy. This strategy focuses on improving operational efficiency when problems are noticeable but not critical. It involves 2 phases: contraction and consolidation. In the contraction phase, a company implements immediate cost-cutting measures to halt losses. For example, Sony CEO Howard Stringer cut jobs and closed plants to stabilize the company. The consolidation phase aims to streamline operations and reduce overhead, but it must be managed carefully to retain valuable employees and improve productivity. Captive company strategy. Companies unable to engage in a full turnaround may opt to become captive to a larger firm, relying on long-term contracts for security. This strategy can reduce operational scope and costs while guaranteeing sales. For instance, Simpson Industries became a sole supplier for General Motors, which significantly increased its sales reliance on a single customer. Sell-out divestment strategy. If a company cannot recover or find a captive customer, it may choose to sell itself. This strategy allows for a good price for shareholders while enabling employees to keep their jobs. Divestment involves selling off parts of the business that are underperforming, as seen when Ford sold its Jaguar and Land Rover units to focus on more profitable areas. Bankruptcy liquidation strategy. When a company is in a dire situation, bankruptcy or liquidation may be the only options. Bankruptcy allows the firm to restructure under court supervision, while liquidation involves selling off assets to settle debts. This latter approach is often taken when a firm is too weak to sell as a going concern. Companies like Circuit City opted for liquidation due to insurmountable challenges. Management often struggles to acknowledge serious weaknesses, which can lead to a cycle of denial and passivity. A strong board of directors is crucial to ensure that management recognizes when it is time to adopt more drastic retrenchment strategies to protect shareholder interests. Portfolio analysis. Companies with multiple product lines must consider how to manage these effectively to enhance overall corporate performance. Key questions include: how much time and resources should be allocated to successful products and business units? How much should be invested in developing new, often risky products? One prevalent tool for corporate strategy in multi-business corporations is portfolio analysis, which, despite declining popularity since the 1970s and 1980s, is still utilized by about 27% of Fortune 500 firms. This approach positions corporate headquarters as an internal banker, treating product lines and business units as investments aimed at generating profitable returns. Research, such as our Kinsey & Company study, indicates that companies actively managing their business portfolios through acquisitions and divestitures create significantly more shareholder value compared to those that adopt a passive approach. Portfolio analysis is also increasingly applied to assess the impact of strategic alliances on corporate objectives. Two widely used portfolio techniques include the BCG Growth Share Matrix and the G-Business Screen, which help in evaluating and managing business units within the corporate portfolio. BCG Growth Share Matrix. The BCG Boston Consulting Group Growth Share Matrix is a tool for visualizing a corporation's portfolio of investments by plotting each product line or business unit based on its market growth rate and relative market share. The matrix categorizes units into 4 types. Question marks. These are new products with potential but require significant investment to gain market share. Management must decide whether to invest in these products to help them become market leaders. Stars. Market leaders at their peak. Stars generate substantial cash and profits. They often maintain a high market share, but can transition to cash cows as market growth slows. Cash cows. Established products that generate more money than needed to maintain market share. Companies typically milk these products for cash to invest in new question marks, often reducing marketing and R&D expenses. Dogs, units with low market share in unattractive industries that generate minimal cash. These should be sold off or managed carefully for their limited cash contributions. The BCG matrix assumes that higher market share leads to cost advantages due to economies of scale. It helps companies project future positions of their product lines and identify major strategic issues. The goal is to maintain a balanced portfolio that supports new products with cash from mature, declining ones. While the BCG matrix is user-friendly and quantifiable, it has limitations, including oversimplification of categories, questioning the direct link between market share and profitability, ignoring smaller competitors, and focusing solely on market share as a measure of competitive position. This slide highlights the limitations of the BCG growth share matrix. Let me explain them. Oversimplification. The matrix uses only high and low categories for market share and growth rate, which oversimplifies reality. Many businesses fall in the middle, but the model forces them into extremes. Questionable link between market share and profitability. BCG assumes that higher market share always leads to higher profitability. In practice, this relationship isn't always strong or direct. Narrow view of industry attractiveness. Growth rate is the sole measure of industry attractiveness in the matrix, but other factors like competition, regulation, technology also play critical roles. Competitor limitation. The model compares business units only to the market leader. This ignores smaller but rapidly growing competitors that could disrupt the market. Limited view of competitive position. Market share is treated as the only indicator of competitive strength, but other aspects like innovation, brand loyalty, cost efficiency, and distribution networks are equally important. Advantages and limitations of portfolio analysis. Let me explain the advantages first. 1. Individual evaluation. Encourages top management to assess each business unit separately, setting objectives and allocating resources accordingly. 2. Data utilization. Stimulates the use of external data to enhance management decision-making. 3. Cash flow awareness. Raises awareness of available cash flow for expansion and growth initiatives. 4. Facilitates communication. The graphical representation of data aids in clearer communication among stakeholders. Now, limitations. 1. Difficult segmentation. Defining product and market segments can be challenging. 2. Standardized strategies. It may promote standard strategies that overlook unique opportunities or may not be practical. 3. Subjective judgments. Positions in the analysis can be based on subjective assessments rather than objective data, creating an illusion of rigor. 4. Value-laden terms. Terms like cash cow and dog can lead to negative self-fulfilling prophecies about product performance. 5. Unclear industry attractiveness. It can be difficult to determine what makes an industry attractive or to accurately assess a product's life cycle stage. 6. Potential profit reduction. Rigid adherence to portfolio models may harm corporate profits if applied inappropriately, as illustrated by General Mills' successful biscuit brand, which could have been dismissed based on conventional portfolio analysis. Managing a strategic alliance portfolio. Strategic alliances can be viewed as a portfolio of investments that encompass money, time, and energy, much like product lines and business units. Effective management of these alliances is crucial for enhancing corporate competitiveness, as they serve as significant sources of competitive advantage. Key aspects of managing strategic alliances. Business unit responsibility. The primary management of strategic alliances typically falls to individual business units, though decisions may escalate to the corporate level. For example, Tuman Corporation manages numerous international joint ventures and emphasizes the need for corporate understanding of how alliances impact individual business units. Multi-alliance management tasks. Portfolio strategy development. Each business unit should create a portfolio strategy, while the corporate level establishes general policies for alliance management. This ensures that all alliances align with corporate strategy and values. Portfolio monitoring. Alliances need to be assessed based on their objectives, financial performance, resource contributions, and relationship quality. The degree of corporate monitoring may decrease as diversification increases. Coordination for synergies. Greater coordination is needed at the business unit level to manage interdependencies among alliances effectively. Coordination becomes increasingly important with more alliances and partners. Alliance management system. Establishing a formal system with standardized processes and specialized units supports multi-alliance management. Most companies create centers of competence for alliance management, often centralized at the corporate level, but with decentralized day-to-day management by business units. In corporate-level strategy, creating value in the multi-business company, authors Campbell, Gould, and Alexander highlight two critical questions for corporate strategists. Which businesses should the company own and why? What organizational structure and management processes will enhance performance across business units? While portfolio analysis attempts to address these questions by assessing industry attractiveness and managing cash flow from mature units to fund new products, it often overlooks the issue of industry selection and synergy among business units. Portfolio analysis tends to view business units as separate financial investments. In contrast, corporate parenting focuses on leveraging the resources and capabilities of the parent corporation to enhance business unit value and create synergies. The concept of parenting advantage suggests that effective parent companies create more value than competitors could if they own the same businesses. This is achieved when there is a strong alignment between the parent's strengths and the needs of its business units. Research shows that companies with a good fit between their strategies and parenting roles outperform those without such alignment. This approach aids in decisions regarding new acquisitions and the management of existing units. An example is General Electric under CEO Jack Welch, who emphasized profitability and knowledge sharing across the organization. The primary role of corporate headquarters is to foster synergy among business units by providing resources, transferring skills, and coordinating shared functions to achieve economies of scope. This aligns with the concept of a learning organization, where knowledge and capabilities are shared throughout the corporation. For instance, Procter & Gamble encourages collaboration among its business units to drive innovation, exemplified by the development of Crest white strips, which utilize knowledge from its laundry division. Developing a corporate parenting strategy. Campbell, Gould, and Alexander outline a three-step analytical process for developing an effective corporate parenting strategy. Examine strategic factors. Assess each business unit or target firm in acquisitions based on its strategic factors. Business units often identify these factors when formulating their strategies. Establishing centers of excellence can help leverage recognized capabilities across the organization. Identify performance improvement areas. Analyze each unit for potential improvements, referred to as parenting opportunities. For example, 2 units might achieve economies of scope by merging sales forces, or a unit with decent but improvable manufacturing capabilities could benefit from the parent company's expertise. Corporate headquarters can identify improvement areas that business units may overlook due to their focus on specific industries. Assess fit between parent and business unit. Evaluate how well the parent corporation's strengths and weaknesses align with the needs of each business unit. This includes determining whether the parent possesses the necessary resources and capabilities to address the identified parenting opportunities, and if there are any misalignments with the business unit's critical success factors. Horizontal strategy and multi-point competition. Horizontal strategy is a corporate approach that spans business unit boundaries to create synergy and enhance the competitive position of one or more units. It operates similarly to a parenting strategy by fostering cooperation among units, and can serve as a competitive strategy in multi-point competition. Multi-point competition occurs when large, multi-business corporations compete against each other across various markets. In this scenario, a financially strong competitor may work to increase its market share in a specific area, potentially harming another corporation's business unit. While each unit typically manages its own strategy, corporate support may be necessary when facing aggressive competition. For example, if Johnson & Johnson develops a new toilet tissue to compete with Procter & Gamble's P&G Charmin, it might adopt a low pricing strategy to gain market share quickly. P&G, recognizing the threat, might choose not to engage in a price war, but instead retaliate by targeting J&J's baby shampoo in a different market. This dynamic of multi-point competition can lead to mutual forbearance, where companies behave conservatively toward one another, reducing competitive rivalry. As firms recognize that aggressive actions in one market could provoke responses in others, they may opt for a more cautious approach. This trend of multi-point competition is expected to increase as companies expand globally and form strategic alliances.
Thank you for watching. If you liked this video, please like and subscribe to channel.